and welcome back to Insight to Invest, the channel that gives you insight into a company and you decide how to invest to grow your money. Microsoft is down nearly 26% this year. Its worst single quarterly performance since the 2008 financial crisis. One of the most dominant companies ever built, sitting near a 2-year low. So what broke? And is this the opportunity of the decade, or just the beginning of a bigger problem? Let's break it all down. At its peak in July 2025, Microsoft was trading at approximately $555 a share. Fast forward to today, and you're looking at a stock hovering around $357, a drop of about 36%. From those all-time highs. Year to date, we're looking at a decline of 25%. The company just reported record revenue. So what's going on? So here's the story in one sentence. Microsoft is spending an absolutely staggering amount of money on AI infrastructure, and Wall Street is nervous about whether it'll ever pay off. In Q2 of fiscal 2026, Microsoft reported revenue of $81.27 billion, up 17% year over year, beating estimates. Net income hit $38.46 billion. Those are ridiculous numbers, but buried in the earnings report was a figure that sent investors running. Capital expenditures of $37.5 billion in a single year. That's a 66% jump from the same period last year. And for all of fiscal 2026, CapEx is projected to hit $146 billion. That money is going toward NVIDIA Blackwell GPUs, Microsoft's own AI chips, and a massive global data center build-out. One Wall Street analyst put it bluntly, CapEx is growing faster than we expected, and Azure is growing a little bit slower than we expected. That brings us to problem number 2. Azure growth decelerated. The first time in years, growth in Microsoft's flagship cloud platform came in softer than expected, and management admitted that supply constraints in data centers will persist through at least June 2026. You're spending more, growing slower. That's not a great combination to pitch to investors. There's also an OpenAI concentration risk people are waking up to. It came out that OpenAI accounts for roughly 45% of Microsoft's cloud backlog, a figure representing around $280 billion in potential exposure. OpenAI is not profitable, and Amazon just signed its own $50 billion deal with the AI startup, complicating Microsoft's exclusive relationship. Investors don't like that kind of uncertainty baked into a $3 trillion company. Layer on top of that, macroeconomic pressure, a hiring freeze announced across cloud and sales units in late March, and geopolitical tensions around Iran rattling the broader market. And you've got a perfect storm for a sell-off. Can it recover? Here's what the bears are missing. The fundamentals of this business are still exceptional. Microsoft's gross margin sits at 68.6%. Operating margin is still above 46%. Return on invested capital is 27%. And the company is sitting on nearly $90 billion in cash with minimal debt. This is not a company in distress. This is a company in investment mode. The CapEx surge isn't reckless spending. Microsoft has $625 billion in commercial backlog, and then also assuming that OpenAI is successful, essentially future revenue already committed by enterprise customers. Azure is still the preferred platform for enterprise AI adoption. And Satya Nadella said something on the last earnings call that's worth sitting with. We are only at the beginning phases of AI diffusion. Wedbush analyst Dan Ives, one of the sharpest tech watchers on Wall Street, framed it this way. Wall Street wanted less CapEx and faster AI monetization. Microsoft is saying this is a multi-year journey and we're building the infrastructure the world will run on. Both things can be true simultaneously. The key catalyst to watch is Azure growth acceleration in the second half of 2026. Once supply constraints ease and those freshly built data centers come online, revenue should follow the infrastructure spend. Microsoft's next earnings report drops on April 29th. That could be the inflection point. So let's talk numbers. At $357 a share, how does Microsoft actually look on a valuation basis? The forward PE is around 24 times earnings, its lowest multiple since 2016, and briefly trading below the S&P 500 multiple. For a company growing revenue at 17% with 46% operating margins, that's a historically compressed valuation. Morningstar puts the fair value at $518, implying Microsoft is trading at a massive discount. Guru Focus GF value model comes in at $536, rating the stock significantly undervalued. A DCF model from Alpha Spread pegs intrinsic value around $394, still above today's price. The Wall Street consensus: 54 buy ratings, 3 holds, and 0 sells out of 57 analysts. The average price target is around $590, representing a roughly 65% upside from current levels. One 12-month target from 24/7 Wall Street's model comes in at $487, with an optimistic case of $601 per share. Now, important caveat: those are analyst targets, and analysts have been wrong on Microsoft before. The DCF models also disagree widely depending on how you model the CapEx impact on free cash flow. If you run a pure free cash flow DCF right now, the heavy spending depresses the number significantly. It also comes down to whether you believe the $146 billion in annual infrastructure spend generates returns over the next decade. If you do, the stock looks cheap. If you don't, it's a value trap. And of course, the price may continue to fall. So here's where we land. Microsoft isn't broken. It's making the biggest infrastructure bet in its history, and the market is pricing in impatience. The fundamentals are strong, the backlog is enormous, and 95% of Wall Street analysts think the stock is a buy at these levels. But timing is everything. The real risk here isn't the company, it's the timeline. If Azure growth doesn't reaccelerate in the second half of 2026, and Copilot monetization keeps lagging, this stock could stay cheap for a while. Watch the April 29th earnings closely. At $357, long-term investors are getting one of the world's best businesses at prices not seen in nearly a decade relative to earnings. Whether that's good enough for you depends on your time horizon and your conviction in the AI build-out that is playing out. So remember, this is not financial advice. Always do your own research. If you found this breakdown useful, drop a like. It genuinely helps the channel. Subscribe if you want more deep dives like this every week. And let me know in the comments, are you buying Microsoft at these levels? Or are you waiting it out? Take a look at these videos that YouTube thinks you will like. See you in the next one.